The 2023 housing market crash is worsening as housing prices are down by an average of 2.35%. Reliable indicators are flashing red, suggesting that a massive storm is coming that will rival the great financial crises of 2007. Real estate values tend to follow volume and inventory as it comes down to the simple relationship between supply and demand. If you plot the monthly supply of houses versus prices, you end up with a graph that shows as supply gets constrained, the future home values increase, and as supply gets expanded, the values decrease. Today, the supply situation is relatively tight, which normally would suggest that home prices should continue to go up. However, there is a big piece of missing information that is changing the entire theory and challenging everything we know about housing values. Prices are down, but inventory is supposedly tight. Or is it? Looking at the new home supply, we can see that it has a higher correlation with future home value growth, which indicates that it should be looked to as a reliable predictor of what is to come. The new home supply has a significant premium that tends to act as an anchor for the rest of the market, dragging prices in whatever direction home builders are pushing. The new home supply chart looks very different from the existing supply chart, and the difference or spread between the two is at an all-time high, causing many experts to question both the accuracy and reliability of the existing inventory data. The new home supply is behaving worse than what we saw in 2008, and percentage-wise, we've had a sustained expansion, with the total number of homes now approaching the highest last time. This happened, and we got the worst housing crash since the Great Depression. Mortgage applications are currently at their lowest level since 2015, down 35% since this time last year. Interest rate hikes are slowing down for now, but there won't be a permanent stopping anytime soon. As long as that's the case, it is wise to allocate some of the portfolio to alternatives. One asset that historically thrived in this sort of economic climate is contemporary art. Contemporary art pieces have outpaced the S&P 500 by 131% from 1995 to 2022. Masterworks is the biggest platform for investing in art, and in the last 12 months, they've made 11 positive exits and paid out tens of millions to their investors. Outlets like CNN, CNBC, and the Wall Street Journal are catching on, and over 617,000 people have signed up so far, and demand is so high that offerings have sold out within minutes. Looking back at new home sales, evidence suggests that we are in the middle of a perfect storm. The new home supply measures the inventory of new homes, and from August 2020 to now, supply has increased by 160%. While this growth is concerning, it is not a shocking fact. However, when combined with other factors such as low mortgage applications and the sustained expansion of new home supply, the outlook for the housing market is not optimistic. Additionally, there are reports of a slowdown in the global economy and a potential trade war that could have a ripple effect on the housing market. The pandemic has also had a major impact on the housing market, with many people losing their jobs and struggling to make mortgage payments. As a result, many homeowners are selling their homes and the supply of homes on the market is increasing. All of these factors are contributing to the current state of the housing market and the potential for a major crash. So what does this mean for the average person looking to buy or sell a home? Well, if you are looking to buy a home, it may be a good idea to wait and see how the market develops over the next few months. If you are currently a homeowner and considering selling your home, you may want to act quickly before the market crashes and home values decrease even further. However, it's important to keep in mind that real estate is a long-term investment and there will always be ups and downs in the market. While it may be tempting to try and time the market, it's impossible to predict exactly when a crash will occur or how severe it will be. In the meantime, it's a good idea to diversify your investment portfolio and consider alternative investments such as art or real estate investment trusts, REITs, that are less tied to the housing market. These investments can provide a hedge against a potential crash and offer the potential for long-term growth. In conclusion, the current state of the housing market is cause for concern, with reliable indicators flashing red and suggesting that a major storm is coming. The supply of new homes is at an all-time high, and the difference between new home supply and existing home supply is causing many experts to question the accuracy and reliability of the data. While it's impossible to predict exactly when a crash will occur or how severe it will be, it's important to stay informed and take steps to protect your investments. By diversifying your portfolio and considering alternative investments, you can help mitigate the potential impact of a housing market crash and position yourself for long-term growth.